We had some information, some economic information the last few days. Today in particular, we had gotten the retail sales, business inventories, of course the oil number, which was a little bit bearish, but we'll talk about that. And I was actually out for the beige book, so I'm going to have to take a look back and see what the info was on that, although it looks like it was fairly benign with regard to the market. You know, I don't really put that much weight on the beige book when you have Fed governors speaking every other day. I mean, it just seems like the beige book every day with these guys. I mean, it's like kind of like the Gong Show with Fed governors, and everyone has an opinion about something, and, you know, so on and so forth. So the economic data, the one that's really the important one, in my view, is the GDP number. We know that there was a revision up for Q4. They were expecting 1%, and it was like 1.4%. But the problem is that Q1 is tracking very weak at 0.4% GDP growth. We know that the IMF came out yesterday, Miss Lagarde, and Lagarde, I don't know, however she pronounces it. She came out and they lowered their world estimate for global GDP. The U.S. GDP was obviously lowered, so growth is stall speed here. The Fed in recent communiques has mentioned that they don't expect inflation to be a problem. If anything, they're worried about it being at a risk to the downside, meaning deflation. So all of that being said, I've discussed before the Fed futures and the probability of rate hikes, and there is nothing above 50% until you get to December. Let's see. Yeah, there's really nothing. July is, June and July are really low. I mean, 18% and 30%. September, which had been up to 50% at one point, is at 42%. November, 45%. And then December is 58%. I guess that's the one and done theory when they had raised last year and talked all this, you know, this tough talk about 4 rate hikes this year, and now it looks like there's going to be one, if it may be none. I mean, we'll see. So the first quarter for the last 3 years has been seasonally slow, and we're off to another slow one. So I don't really see any reason why the Fed would be in a rush to hike here. It would be a huge mistake hiking into a slowing economy. The real reason for rate hikes is a roaring economy that's out of control. We know we have anything but. And a inflation problem. And we already know from the Fed that there is no inflation. I think that there were some comments, then there are some more Fed governors talking later in the week, that if oil and energy really got out of control again, that could prompt them to move. But I really don't. I mean, I'm a little bullish on oil. I've said for a while I think we're going to see $50. I still think so. But I don't know if it's going to be a straight shot, and I would say you're hard-pressed to say that oil in the 40s is out of control expensive, given where it's coming from up at $110. There was some durable goods issues. The auto numbers were out the other day. They were pretty atrocious. That's in line, basically, with my theory about peak autos. You know, the dirty little secret about the housing market and the autos, which have kind of been the durable goods that have been holding up the economy, is that you need low interest rates for both. If you start raising interest rates on either or both of them will not do well. It'll be a problem. So I think the Fed is very keenly aware of that and are looking to keep rates lower for longer, right? That's the thesis. The jobs numbers we know are not good. We have a lot of seasonal hires, I guess caddies, carnival ride operators. I joke around about that, but it's really real. It's actually a line item. The economy is weak. These are not the high, paying jobs that we've had in the past. A lot of temporary work. A lot of companies are trying to, circumvent the Obamacare tax. They're hiring part-time or they're keeping people on part-time. It's not full-time jobs. So when you really factor in the amount of people who are part-time who want full-time and the people who've been unemployed so long that they no longer count, my guesstimate, back of the envelope, and I'm eerily accurate on a lot of these numbers, is probably in the low to mid-teens at this point. I've heard arguments where people make it into the 20s. I think that was probably the case a couple of years ago. I think it might be a little bit extreme here. But we have a very weak economy with very poor paying jobs, and I've made the thesis that we don't only have a cyclical issue, meaning the ebbs and flows of the business cycle, but we have structural problems with people not being trained properly for the right jobs. And I've discussed at length, and I will continue to discuss my big theme of artificial intelligence and automation hurting not only low-paying jobs, but I believe will start bleeding into the white-collar jobs soon. So that has set the backdrop for a fairly dovish, benign Fed, and I think that that is a game changer. A lot of people poo-pooed Yellen's speech. They said that it was no big deal, but it has turned out to be a big deal, and the market is like in spitting distance of all-time highs. And it would not surprise me that to see that we would maybe make new all-time highs. I'm going to discuss my theory about that right now. With regard to SPY, for the rest of the week, the options market is factoring in. Let's talk about the VIX first. It's really low. It's only factoring in $1.61-ish worth of move, which basically gets you up to those 109s, which I talked about in the weekend review video. It's not 109s, 209s. 208.97 is an important level, as is the basically the figure of 209. I think that could be a little bit of resistance short term. With regard to let's finish up with SPY, right? We already started on it. And then I'll back into the VIX. And I also have the SPY chart above in front of me. So we had the Fed, the Yellen day, which was 329. That basically took you to the high end of range, and the next day was a gap up. I had asked people what their opinion of that was, whether they thought it was bullish or bearish, and I was amazed at how many people thought it was bearish. You had breakaway value that day. It made to me no sense that you would think it was bearish. I did, however, say that I thought it was possible that we would retest the 204.12. We did in the subsequent days. You had two consolidation days up there. The next day was a big move down. Basically, it wasn't quite a Maribozo candle. For those of you that aren't as familiar with Japanese candlestick charting, there's a book by Steve Nissan. It's overpriced, but if you want to know about it, you can read about it. A Maribozo candle is basically opening up at the dead low and closing at the dead high. This did have some wicks, but it was a really big body candle. The next day, which so many people were bearish on, was basically a consolidation day. At that point, I was still pretty bullish. I'm thinking that the market would go higher, but I did note that 206.76 was a resistance level, and that held for multiple days. You had three look above at that point and fail. The next day was a little bit odd for me. We had the market down pretty severely and retesting the 204.12 level, and actually, I believe, closed. No, we still held it. I'm sorry. We still held it that day. And I think that was basically kind of like a bit of a double bottom. The next day, you had another one of these big up candles that closed basically, opened basically near the lows, closed at the highs. And then the following 3 days were very odd. The next day took out the range low. It was a bit of a look below and fail, although it did close weak. We closed at 203.95, which I said was a little inconclusive, but I was a little bit more cautious. The next 3 days, you basically had gap ups that crapped. Gap and crap. You had up days that spent the whole day selling off, but the key there was that it was still on positive breath. I kept on mentioning, and I mentioned in the weekend review, that it was very strange to me to see the market, first of all, everyone was super bearish. My whole stream was really bearish. I was not so, because I kind of go by the levels. I think at that point, everyone, and even I was starting to question, could we still hold on? Could we still hold the 204.12 level? We actually even had some closes a little bit below there. We were closing around 204, 204.50, 204.02. Can't be. Yeah, was 204.50. All right. And then 204.02. So we were kind of just holding on to that 204 by the skin of our teeth. Let's keep it a little bit PC here. So we were holding on basically barely. And I think what everyone always assumes, and listen, the more times you test a range, the weaker it gets, but it wasn't looking right to me. If we were going to really go through it, we should have been on negative internals, not 1-to-1 or 2-to-1 positive on the NYSE, and then Nasdaq is flat or a little bearish. I mean, yeah, I mean these readings had opened up stronger, but they still closed pretty well with regard to your internals, and you didn't have like really major sell-offs in big names. Oil was also kind of hanging out and being strong. I always like to say, wait for the break of range. Don't anticipate it. And a lot of people loaded up those 3 days short. I talked about anything over those 3 days highs would be a long. Yesterday, once again, you had one of those kind of look below and fails, close strong, and then today was no surprise. We had a gap and go to the upside. It took a little while in the morning. The gap sometimes needs digesting. The breadth today wasn't like crazy bullish, but it was pretty bullish. The NYSE was 3.33 to 1 positive. The Nasdaq was strong. That was trend day, entry level trend day readings, which was over 5 to 1 positive. I always say if you're over 5 to 1, 5 to 8 to 1, that is trend day type of internals. If you can, both to the upside and the downside. If you're 5 or 8 to 1 or more, negative or positive, you tend to have one of those trending type of days. So we had it. Today was definitely one. You basically opened up, took a tiny little dip lower, and basically closed up near the highs. The good news is that the gap today, you could have kind of anticipated a little bit, even from the gap, because it was a gap over the 206.76, and it's going, and we're starting to now hit right. The good news about all of that chop is now that 204 should be a rock solid support. If that ever failed again now, I would say it is a major short. That being said, we are over multiple days of consolidation. After the Fed, you now have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days of consolidation. You have a 20-day moving average that is caught up tremendously. It's in the it's basically 205. It's 204.90. The 50-day moving average, the 100-day moving average is down in the 199s. The 50-day is down in the 198s, but moving up quickly. And the 200 is around 201.44. It's starting to bend up. The key to me, though, when you look to see how overbought you are or oversold, is how extended you are from the 20-day moving average. We had been quite extended at certain points in this run. However, we are not that extended anymore. It is caught up a lot. You've had 10 days to consolidate up here. It's often been said you don't have this long to sell the highs. Yeah, I guess not. I mean, the market really did consolidate. It had every opportunity here to break. I mentioned that we could have a bit of a secure low forming. It took a couple of days to kind of confirm, but it seems to me now that we're going to want to, at the very least, test the downtrend line. That's not that much more ahead of us. It's about 209. I'll say this much. We consolidated a lot here, and we're not that far from the trend line. To me, that says that that trend line might give. We could have a break, fill up the triangle, and get to the 210s and 211s, and maybe even beyond. Anyone who is short now underneath today's lows in that 10 days, the people were shorting, they're all wrong. They're run over. The price is higher now, and it did so in a bit of a gap fashion. So you have to, obviously the gap has to hold. You know, if we start looking into it, you know, you could start negating, and today could have just been a look above and fail. But it seems to me like we're going to, at the very least, test that downtrend line and maybe even peek over it. I'll tell you why I think that. I promised I'd do VIX, but I really want to do Apple. Let's do VIX quickly. VIX has now had 1, 2, 3, 4, 5 attempts to get back into the channel. I'll show this in graphic detail in my weekend review video. It is failing miserably. It was starting to try to make some higher lows in the 14s. Today you basically gap and went below the 20-day. Not good. I don't necessarily know that we're going to get this huge contraction in IV here, although I would love to see it get down into like a single. If we could get a single-digit print, you got to load up on IV at that point. But it seems to me that it is going to come low, or at least stay a little bit lower. I think a lot of the kind of giddy up that you've had the last few days in the IV was just people kind of putting on protection and repositioning. You had at the end of the quarter, and this is now Q2. So I think people were just kind of rolling off their the protection may have came off, and now they were just putting some new stuff on. So there was an underlying bid that kind of propped it up with regard to the market. Now we'll get to what I wanted to really talk about. Apple and oil. Apple today did something it hasn't done in, the stock has been in a downtrend for a year? Since July. Yeah, July. It's been in correction mode or downtrend for a while. Today, we were a gap and go above the 200-day moving average and the downtrend line. Apple has now broken the downtrend. That is significant. That stock alone can do tremendous movement for both the NASDAQ and the S&P. You had a kind of a look above and fail. Let's see, this was one on the 4-4. I mentioned that I thought that would be resistance, and I wanted to see how big the back off would be. I said if we can hold anywhere from 207.31 to 209.14, it was shallow and that we would probably punch through. That played out to the T. The last high there was 112.19. Today's high was 112.34, although we didn't close over the old high. I would have liked to have seen a close over that high, but we kind of got close. We're at the 112s. You could now, in my view, use today's range as a guide. Anything below the low, and that's 110.80, you can play row short. Anything above the high, 112.34, you can play right or right out long. That, to me, is the play. I would say that the key to today's low is that you have the low of day is the over the channel high, and you have the 200-day. You really should not see that happen again. If this were to go, there is a lot of room, believe it or not, up to like 119, 120. 119.75 is a really key level. There's also, basically the gap fill there to close to 120. What's the gap fill here? 120.56, 57. I will say this: there's a proprietary level in there that no one else is going to mention because they aren't me. But there was an old uptrend line, and the backside of that uptrend line is currently in the 115s. And that's also the kind of the next high volume node. So I would be looking to trim, and I will be looking to trim up into the 115s and up into the 119s. That is the area. You can now, I believe, use a stop below today's low. There is a mini gap fill there to 110s. So if you want to, give it a little room, you could give it a little bit more. But I tend to like to give it where I give it. And I'll stick with today's range. We had the curious case of oil. All right, so we know we have this Doha convention or whatever this weekend. There's supposedly a deal between Saudi Arabia and Russia that they're going to have a production freeze, not a cut, but a freeze. And I heard it's regardless if Iran is going to be involved. And then I heard today that it might be very loose, loosey-goosey about what happens. Anyway, it was enough to react and get oil higher. We now have 2 consecutive days, mini topping tails into some reference resistance in the 42s, but we have 2 days back-to-back closes over the 200-day moving average, which is the first time in maybe since my bar mitzvah. Jeez, let me take a look. I don't remember the last time that we closed over the 200-day moving average. The last time we were above the 200-day moving average was 7:30. Interesting, around when Apple peaked. Oil had also started the real breakdown. Could those two be correlated, I wonder? Anyway, I think that we could see higher in oil. Anything above 37, to me, the risk is higher. Anything below 37 starts to get a little bit iffy. That was the breakout of the high of the range from the 2008 and 2009 crash low. I think we're bowling for 49.50, 49s to 50s. I think that's where we can go. Yes, there could be a pullback. Oil could pull back, but the trend here to me is we're making higher lows and higher highs, and we had the opportunity to have a pretty sizable pullback multiple days, and we're basically back to where we were before the breakdown. So I'm kind of bullish on oil. Yes, there could. We'll see what happens with Doha if they run it. You know, I've heard so many people saying that they're anticipating Doha is going to be a sell the news event. It wouldn't surprise me if they sold it off beforehand and then it was a buy the news event. We'll do the opposite. If they take it down ahead of Doha, we'll be buyers. If they gun it into Doha, we'll probably be sellers. So let's just keep it simple, stupid. We'll do the opposite. Kind of the George Costanza play, if you will. The curious case of Facebook. All right, so we have the stochastics rolling over a little bit. I warned everyone that we were going to start getting this double top talk when we got up to the progression line. This damn progression line on some days shows it's in the 116s, some days it's in the 118s. I believe it's the 116s, although the chart today happens to be a 118 day. There are some levels here that are important. You had a really weird... everything today, until today, what was going as planned. You had the pullback to the 50-day moving average. 2-day hold with a higher low. It closed just shy of the 110.65, but today we ran up. We got to the 20-day moving average resistance. And then there was some kind of bogus story that was out. There's been a couple of stories out about Facebook and maybe them missing the quarter or not having so stellar numbers. I don't know. I mean, to me, that the arguments they've made have been kind of weak arguments. They were saying that traffic to partnered websites is down big because of Facebook's new feature where they basically keep you in app. You can expand the story and read in there. I mean, duh, didn't everybody know that was going to happen? I mean, the whole design was to keep you in app. To me, it's a genius move by Facebook because everyone always talks about monthly average user use, monthly average users. This, to me, would get the usage up much higher, and I think it has bigger implications longer term within Facebook once they start selling more subscriptions or start selling anything, product or service inside. They keep you inside that ecosystem and don't have you go out to those partner websites. So what is negative for these partners is great for Facebook. People are dumb. They've missed the Facebook story the whole time. You know, the same people who loved it and loaded up at 38 were puking it to me at 20 and now have an opinion again now that it's well up over my 100 target. So I believe Facebook longer term, bulldog mode, bullish mode. Shorter term, there are a little bit of technical issues, and we'll talk about them. We are still now, for the third day in a row, closed below 110.65. That was the last kind of like the left consolidation range. Below there, sorry, but the stock is a little bit vulnerable. That being said, you had a major look below and fail today. You had this huge flush down to the 50% fib. Remember I talked about the 106.91? Today's low was 106.52. So I was off by a little bit, and that was basically driven by a momentum algorithmic puke. They overshoot a little sometimes. However, we closed well above the 50. At one point, we were above the 2-day high. We closed a little bit softer. So once you lost the 50-day MA today, I think a lot of stops were triggered. A lot of people were stopped out of their longs, and a lot of people were put into shorts. Those shorts are not correct. Those people who were shot out of their longs are probably not happy about it and looking to either get back in. Let's keep it really simple with Facebook. Anything below 110.65, we are in caution mode. Anyone who's a NASCAR fan, we're driving under caution. That means there's a wreck on the track, we're not there yet, and we're going to kind of circumnavigate it. We are not going to be full speed until we are back over that level comfortably. Anything below the 50 MA now to me would be we shouldn't be there, and we might want to be out or right out as a test short, particularly any closes now back below the 50 MA. On the other side, if we close above, or any price action today above today's high of day, I believe we will see new all-time highs in very short order in Facebook, because that would have told me today you got a lot of that. Today could have been the shake and bake, the flush out. I don't know that this is going to happen, and I'm actually hoping the stock goes lower, believe it or not, because I would love to get this thing super cheap into the earnings and then have it rip everyone's face off. But we don't always get what we want, and it doesn't always happen in the order in which we want. So anything above today's high of day, the 112.65, is an absolute plain English right or right out long, and I would use the 110.65, anything below there, as a stop. Very simple, plain English. You heard it here first, folks. That is the Facebook. Amazingly, today there was a story, and I wish the SEC or someone would get involved with this, that came out with a story that basically said that Facebook, there was some issues in tracking. It basically read to me like they might miss the quarter, and then by the end of the day, the story was taken back. It was a mistake. They came out, it was a mistake. That is nonsense. Imagine if you knew that story was going to publish, you shorted the piss out of the stock, and then got to cover, and then, it was no big deal. We were wrong. Sorry. This is the kind of shenanigans that go on, and why people hate Wall Street, and why guys like Bernie Sanders say the model of Wall Street is fraud. I see things like that, like what happened today, and you can't argue with that. Today was BS, and it should not have happened, and someone should be fined, or there should be an investigation. Let's keep it like that. I don't want to judge. Mistakes do happen, but at the very least, there should be an investigation. Fitbit, holy cow. I haven't loved this stock. I will say this though. The pattern to me. You had basically the gap fill. It had a back off to a higher low, came back up, consolidated. And then today now gap and go back into the channel. That to me is impressive price action. I would be really surprised if this stock gave it up here. It's possible. Listen, anything can happen on this tape. The market is coming into some potential resistance. I would be surprised though if this stock doesn't have some carry forward. And keep in mind, I've hated this stock. I've hated the company, I've hated the stock for a long time. People were arguing with me when the stock was much higher in the 40s, and I said it was going to go much lower, and it did. So now I'm telling you I think it's going to go a little bit higher. I like today's range as a guide. Below the low, GTFO, meaning get the F out. Above the high a day, and it's going to be long. If there's some weakness early, like if it has some kind of a move halfway back into today's range, it's a buy with a stop below the low. Very simple. Or a move, or better yet, there, and then if it happens to get above today's high tomorrow also, you add. Very simple. That would be like a JP 101, how to day trade a situation like this. And then of course the stop below the low of the day. That is the Fitbit. This Alkermes is one I'm in. I've been talking about it. I've been liking it. It's getting a little overbought on the stochastics, but it seems like every dip, and it's been consolidating now. You have 5 days of consolidation, 6 days, you could even make the argument. It seems to me like this is going to want to at least test into the gap. The gap starts at 40.28. The 38.2% Fibonacci retracement from the top before the breakdown to the low was 47.60. The gap fill is right at the 61.8 Fibonacci retracement, roughly around in the 60 range. I think we're going to do something like this. We're going to look into the gap. Everyone's going to get excited and not realize it's already run from $27 already. I was talking about buying this thing in the 30s, so I have a pretty nice, let me see, where did I buy it? I don't think it's going to show, but I can tell you how many point gain I have on it. Almost a $9 gain. That's pretty good. Pretty good. So I think it's going to look into the gap, come back down, provide a buying opportunity when everyone realizes, oh my God, the gap isn't going to fill after they've chased it. and then it will set up for a long again, and then fill the gap the second time around. So I'm looking for a little higher here. I'll be looking to book some profits. I'll probably hold some because I just, why not? I mean, I have such a big gain on it. I can, spare to lose a little bit, given that I think it's still going to be coming back from higher. Maybe it does fill it on the first shot. Who knows? The stock feels like there's something going on, though. I have a lot of experience watching how stocks trade, and it just feels like there's news that's coming that we don't know yet, and that the news will be good. So I want to be in for that. Like maybe it's getting a takeover. I don't know that. I don't know anything. I just know that the stock looks like it's been getting bought on all the dips. It has this weakness, and then it's bought, and it looks good to me. So I think that the stock looks like it's doing well. That also kind of coincides with my thinking on this IBB. So far, this has looked like it had gotten some Q2 allocations. It came back down and retested the breakout yesterday, which was the 271.77. Smidgen looked below, today back up. It's looking a little better. It broke out with a big body candle. It did take back all of it a little bit too quickly in my view, but it is coming back up. So, yeah, I mean, as long as IBB is above 275.40 to 271.77, the play is long. Anything below there, something wrong is wrong. It shouldn't be below there. I would be out. Maybe Hillary will be giving a speech again, or something not kosher will be going on that I will not be happy or endorsing. Chipotle. I'm kind of jumbling around these. All right, so here's the deal with CMG. You have now 2 days in a row with back-to-back hammers with a higher low in today's. I like that it was able to hold the 242.40 on both days. It's a little odd. I don't like that it had a bit of a double. It had 4 days of bottoms, a breakdown, a look back above and fail, and now making newer lows. The 454.24-ish area, 453, let's just say 453 to 455. Anything below there is still vulnerable, but I will say this. If you can get above the 2-hammer, the 2-day high, I like it for a right or right out trade long, for a move back up. It could be a look below and, a few days below and fail. You got into an old high again here. There were some other reference lows down here around the 435-ish area. Over tomorrow, let's say over the 2-day high. The 2-day high is 447-ish. Yeah, let's just say 440. Anything above 447, I like long row, meaning right or right out long. And if you got below the 442-ish area again, something's not right. Anything below the the bodies of the hammers, the little hammers, you don't want to see that. And if there's closes below there, it's just GTFO City. All right, Amazon. I don't know how to say it in plain English any better. I said anything over 585 is a long. Did I not? I've said it now for a couple of weeks in the videos. And we are now getting back into where we might want to be looking to trim and trail. I love that it had multiple days of consolidation. You had the big up thrust, the breakout, and then 1, 2, 3, 4, 5, 6, 7, 8, 9. Again, 10 days of consolidation. This is starting to get biblical. And today a gap and go above the range. Good. The 61.8 was 611.47, and the gap high of day from 2 earnings cycles ago is 619.45. You might get a little bit of selling in there. I'd be looking to do a little trim ski and trail ski in that area. The gap fill is 635.35. Yeah, I mean, sure, stick with it. I mean, as long as you're above that 10-day consolidation high, which was 603.24. Anything above 603.24 to me is still, is still bullish. Not seasonally a good time for Amazon either, but it certainly seems to be seasonally good this year, at least early. I wouldn't be surprised to see some weakness later on in the summer, but For right now, it's okay. Google, I'm going to stick by my story. Anything above 652.05, I'd rather be long than short. However, I really like playing Google at the extremes of the range, shorting the channel high or buying the channel low. I'm not going to change that theory. Exxon, I've talked about ad infinitum. I don't really want to go there again, but anything above 83.01 is okay. You've now had multiple knocks on the breakdown of the 84.70. There's a volume kind of distribution that ends in 85s, 86s. You know, I think it's bullish. There's a channel here. We're midway through the channel. The channel high is up like, I mean, it's not going to happen tomorrow, but if it did happen, it would be close to 93 and then high 92s. I think Exxon to me looks like it wants to go a little higher. IWM, I got a lot of questions on that today and the last couple of days. We are close to target, 112.62. There's a 200-day moving average and a downtrend line. The other indices are breaking out. I've discussed this area as being a potential for a short. Given the way that the price action is this might not be a short. You might want to wait a little bit. It could get to the 115s. If you must, write or write out, right there. I don't know if I would hold it overnight, but I would try it as a row play, particularly if there's a little bit more of a move up. That's a gap fill on the downtrend and the 200-day moving average. It's just a lot of, you know, a confluence of events. I think at the very least you'll get maybe get a little bit of a back off. If there is a gap and go over it tomorrow, do not play with it. It will run you over. Very simple. So if there's no big gap tomorrow and we kind of open flat and meanders up there, yes. If there's a gap over it, just sit on your hands for a little bit, is my opinion. That's what I think. The Qs looking ever so bullish, particularly if Apple is going to get its Mo back. Slight bit of concern that actually we're getting very close to a gap fill. Also, 111.86. All of these things are kind of lining up here with these levels in these stocks. The downtrend line in SPY, the gap fill in the Qs, the gap fill in IWM. This is really where the rubber is going to meet the road with regard to the market. You know, we've spent a lot of time very close to there. There's a consolidation close to there. So I don't know that this is going to have quite as dramatic of an impact as if we would have just gone in a straight line and not worked off any of this excess. The context is always really important, and it seems to me like there could be a little bit of an overshoot and then a little bit of a hangover. So what I would rather do than outright short is maybe sell some near-dated out-of-the-money calls. Maybe even do strangles, because I don't think the back off is going to be that dramatic, given we've had this much consolidation. Very near dated, I'm talking about, though, not like a few weeks out. That to me is a no-go. All right, so I think we covered a lot today. This to me, like I said, a lot of people were surprised with today and yesterday. To me, the surprise wasn't today and yesterday. The surprise to me was the past 3 days before leading up to today and yesterday. So let's see, what was that? I guess that was Tuesday, Monday. I'm sorry, today was Wednesday, so you have Tuesday. You have Monday, Friday, and Thursday. Those to me were the strange days that we were selling off on the strong internal. So let's see how we do. I do believe in trimming into resistance. We're getting close. So that's my story. I'm sticking to it. Anyway, I'll go over this in more detail in the Sunday video with the real technical show. I hope you enjoyed the broadcast. If you, like I said, this will be up on YouTube in a few minutes. I'm actually going to put it up now, so it should be up shortly. Anyway, have a good rest of your week, and cheers.